Thanks for stopping by. We're here today to talk about REITs. What are REITs? Why do we use them? And which type of REITs do we prefer? First of all, let's talk about what are REITs. REITs are real estate investment trusts. Let's compare that for a moment to mutual funds. A mutual fund manager's job is to buy and sell individual securities within an overall portfolio. Maybe it's stocks, maybe it's bonds. A REIT manager's job is to acquire real estate, commercial real estate in particular, at the lowest possible price. Now, the question you have to ask yourself when you're looking at REITs is what type of real estate they are purchasing. We prefer REITs that purchase real estate that is necessity-based. For example, healthcare properties, grocery stores. People have to eat. Healthcare is often a necessity. So that's basically the similarities between mutual funds and REITs. Mutual fund managers buy and sell stocks. Real estate fund managers or portfolio managers or real estate management teams buy real estate at the lowest possible price. Why do we like real estate, and why do we like real estate investment trusts for our clients? First of all, when you look at REITs, you can buy non-traded or invest in non-traded or traded real estate. First of all, to invest in non-traded real estate, there are suitability requirements that may apply. Non-traded real estate typically has a stable value share price. Let's call it ABC REIT. ABC REIT offering price is $10. It's $10 today, $10 tomorrow, $10 next week, and $10 the week after. So it's not traded in the markets. So no matter what happens in the Dow, the NASDAQ, the S&P, it doesn't affect the share price of non-traded REITs. What does affect the share price? First of all, when you're looking at real estate investment trusts, let's say, for example, the REIT, the pool, owns 100 properties. If 90 of those properties are on triple net leases, if they're fully occupied, fully leased out, that's a 90% occupancy rate. Let's say, for example, only 50 of the 100 properties are leased out. That's a 50% occupancy rate, probably not all that great. So you're looking for high occupancy rates to keep the stability in the non-traded REIT. Also, we need to make sure that all the funds from operations, because again, a REIT will purchase real estate at the lowest possible price with the intention, often cases, of triple net leasing that property out to major tenants. So is the lease revenue that they're bringing into the portfolio from the triple net leases enough to support the distributions to shareholders? Now, this is what our clients really love about REITs. The distributions to shareholders currently are in the range of 6 to 7%. It varies depending on the offering. Now, that is an annualized rate, but it's paid monthly. It's great, predictable, reliable monthly retirement income, and that's why we often use REITs. So in the non-traded world, we have a stable value share price, and we typically have a stable dividend or stable income stream generated from the REIT. What we don't have in the non-traded REIT side is liquidity. Typically, the offering or the hold time from start to finish or start to liquidity event may run in the neighborhood of 4 to 6 years. Now, depending on when you invest in a REIT will determine your hold time. For example, if you buy in at the beginning of an offering, the idea that your hold time is going to be longer is much higher, much greater. If you buy in the middle of an offering, you may be looking at a 2 to 3 year hold time, or if you buy at the end of the offering, you may be looking at a much shorter hold time. You really never know. Now, here's what we look for at Brookstone. When ABC REIT formed day one, they file papers to file as a REIT company. Let's say they set out to raise $1.5 billion or sell $1.5 billion worth of shares. This is public record. It's also public how much they have raised to that point. Well, let's say that we see that ABC REIT Company has raised $1.4 billion. Well, if ABC REIT has raised 1.4 out of their $1.5 billion target, we know we're at the tail end of that offering. That may be a great opportunity, but here's where our due diligence comes into play. We have to determine, over this long established track record to date, have they covered their distributions to shareholders, and what type of properties are they acquiring? So once they close, once they meet this cap, they raise all the money, they sell all the shares, what happens next? In many cases, what happens, not all, but in many, they go into what we call an incubation period. During the incubation period, they are determining their exit strategy. Exit strategies can vary. Exit strategy could be a merger with a publicly traded REIT, could be a listing on the major exchange. Let's say in this example that it is a listing on the major exchange. Well, first of all, when the REIT closes, no new money is allowed in. They're still paying the dividends to the shareholders. Nothing changes there. You're still receiving your predictable, reliable monthly income. But what's happening during this period of time is they are filing for their offering or their publicly traded listing. Once the filing process is complete, and again, in this example, we'll assume ABC Company does list on a major exchange, then the price becomes more volatile because at that point, it's a stock. It's a publicly traded REIT, which brings full liquidity to shareholders, but it also ties in more volatility in the current distribution rate. Now, there's many mutual fund companies out there today that have what's called real estate indexes. And when you buy a real estate index, you're basically buying a proportionate share of many publicly traded REITs on the market. At the 6-month mark after the listing is what we call index inclusion, and it's near or around the 6-month mark. At that point, many of the mutual funds that offer real estate indexes may be required to buy their proportionate share of ABC REIT Company, in this example, to remain a true index. Well, as you know with the markets, buyers drive prices up, sellers drive prices down. When these orders come in, and these are often large orders, many times those orders push the share price upward. We're looking for that initial pop, not guaranteed, but often there as an opportunity. We're looking for that initial pop in the share price to take our gains and roll right back into a non-traded offering nearing its exit. Now at Brookstone, we have been living in this little world with a proportionate allocation of our clients' portfolio, sometimes 10%, 15%, up to 20% in many cases, but identifying opportunities with non-traded REITs on the tail end of the offering with phenomenal track records, fully covered distributions, so our clients receive current income, predictable, reliable current income, an initial pop on the share price. Now, what happens once it becomes publicly traded, again, is not always guaranteed. So some of our clients prefer buying earlier on in the offering for a longer period of predictable, reliable monthly income. Some of our clients, again, though, prefer to buy at the tail end of the offering in anticipation of capital appreciation at the liquidity event. So whatever the reason why you're considering REITs today, whether it's for current monthly income for retirement, or maybe it's the capital appreciation opportunities in the real estate world, you've come to the right place. Let's talk about the type of real estate, though, we're considering for our clients. First of all, what is happening to 10,000 baby boomers each and every day? That's right, 10,000 baby boomers every day are turning 65. That trend will continue for the next 15 to 17 years. The aging population creates great opportunity in the healthcare world. We prefer REITs that are buying facilities like adult daycares, assisted living centers, and nursing homes. Think about it for a minute. The likelihood that the occupancy rates in these types of facilities will remain high over the coming years is very good. Also, healthcare comes out of necessity. It's not speculative, such as REITs that maybe buy strip malls that lease out to mom and pop tenants. We love healthcare real estate. We also like real estate or real estate investment trusts that are purchasing grocery store real estate as their anchor tenants. Because think about it, two things: people have to eat, and healthcare is a necessity. If you would like more information on the REITs that we are suggesting and offering to our clients at Brookstone Financial, simply complete the form on our website and we'll send you an entire list, both snail mail and email, of everything we're offering to our clients and exactly why. Thank you for stopping by.